What's the first step to a mini merger? Who can help me walk through this? What's the first piece to a mini merger model? Anybody?
Information.
Sorry?
Collecting information.
Collecting information. What's the first technical modeling step?
Assumption.
What kind of assumptions?
Equity debt.
I don't know how much you get paid for them.
How much who gets paid for them?
Like how much the acquirer's going to purchase the items for?
Yes. Purchase price. The purchase price. And the techniques at how to arrive at a purchase price or how to get to a good valuation, you'll learn with Nate on Friday. Valuation. What are the drivers? What are the main methods and metrics to arrive at a reasonable purchase price? But we'll save that conversation, and we'll assume now for the mini merger, for the full-blown, that the purchase price is some assumed premium above the current trading value of the target business. If we assumed 40 to 25%. There are some common methods to help establish what is an appropriate premium, an appropriate purchase price. What's the next step?
Financing methodologies.
Sorry?
Financing methodologies.
The financing what?
Method of financing.
And what method of financing?
Yeah.
So, the sources of financing and the uses of financing. And so, for example, the uses of financing are what? What are the uses of the financing? Yes. So the uses represent where the money's going. Right? The money is going to obviously the purchase price. Right? Effectively paying for the business, buying out the shareholders. Right? The purchase price is representative of the money that you will use to convince the shareholders to give you their shares, or the owners to give you the business. Right? Plus what Brittany had said, refinancing the target net debt. Right? Target net debt. This is an assumption. Right? We are assuming that in addition to paying for the shares, we have to raise additional funds to pay down the liabilities of the business. Why would we maybe have to do that? It's an assumption. And we're being conservative, so we're going to assume that that might be the case. Why might we have to do that? Yes?
Just to kind of consolidate anything as just like the acquirer's debt instead of like...
Maybe for consolidation purposes, you could maybe get a better rates and you want to just consolidate and refinance. What else? What could be another reason? Yes?
I was just guessing, but if you're a bigger company and you're buying a small company, maybe you can get better terms.
Maybe get better terms. Yep. What else? Yep.
The target probably has some sort of assumable debt in their like clause in their loan.
Yeah, it could be. That's another common case. If the target company has debt and has a contract with the bank, there could be some sort of bylaws or clause in those contracts that say, if there's a major company event like a bankruptcy or a change in control, we want our liabilities to be paid back. And if we're buying the company, that's a major event. We may have to be responsible for that. So again, this is a conservative estimate. We're assuming that in addition to the purchase price, we have to raise additional funds to pay down the target's net debt. And that could be negotiated and things like that, but let's just be simple and assume that. What else? What are other uses? Transaction fees. Right? Lawyer fees, banking fees, you need to raise additional funds to be responsible to pay that. Right? So now that you know the uses of cash, what you need the money for, we need to figure out the sources of cash. Where the money is coming from. And that could be any type of combination of debt or equity And there could be many different types of debts, many different types of equity. There could be additional cash, and we'll talk about all those different pieces tomorrow in the leverage buyouts. But let's keep it simple and let's say we're going to use some sort of debt loan and some sort of equity that we'll raise to fund the acquisition, to fund the purchase price, to fund retiring the target debts, and to fund paying the transaction fees. And your sources, of course, must always match your uses. You need to be able to raise just enough funds to pay for these items. Yeah? So the first step in any transaction that I'd recommend you think about is, number one, what's the purchase price? How much do you need to spend? Then two, what are the total uses? And three, how are you funding that? Once you know these pieces, the third step is actually making the pro forma adjustments. How do we actually combine the operations and the entities together? Right? It's taking the acquirer's business and adding in the target business. Why would we want to do that? What's the purpose of a mini merger? So the purpose of the mini merger model is just to look at, from an income standpoint, will this create value? That's the purpose of a mini merger model. In a full-blown merger model, we'll look at combining the full financials, the full income statement, the full cash flow statement, the full balance sheet, the full depreciation schedule, to see what does the combined entity look like throughout. Yeah? So how do we go through these steps? How do we do it? Anybody remember yesterday? What's the overall mechanical idea behind putting together an acquire and target business? Yes?
Just combine most of the balance sheet items.
Well, we're dealing with income statement, right?
Oh.
Just mini merger.
So combine income statement items to take out any cost savings.
Yeah. So first you literally add together, line by line, the acquire plus target income statement items. Acquire plus target revenue. Acquire plus target cost of goods sold. Acquire plus target overhead expenses. All the way down. Right? Except for items dealing with the target's debt and the target equity. Why is that?
Use in the state.
Yeah. The target company's debt you will have paid down. The target company's equity you will have paid off, right? Your purchase price represents monies used and spent to buy off the shareholders. The shareholders are gone. So the target shareholder's equity is gone. The target net debt is gone. So the idea is, when adding together, when combining two operations, acquire plus target, you want to add together line by line, acquire plus target revenue, all the way down to net income, except for items dealing with target's debt and target's equity. So no target interest expense, right? Interest expense is related to target's debt, and no target shares. Right? So let's step through that line by line. So starting with revenue. How did we combine the acquire plus target's revenue? We literally took the acquirer's revenue and we added it to the target. Right? Acquire plus target revenue. What else?
Expenses.
Expenses. And we were very simple here. We just said cost of goods sold. We said all other expenses were just in one line expenses, just to illustrate the point. You would add acquire plus target expenses. What else? Yes. Adjust for synergies. So, my red marker. Adjustments. I didn't mention adjustments. In addition to adding line by line, acquire plus target, revenue, all the way down, and not including target's interest expense, target's equity, you want to make on top of that 4 transaction adjustments. Yeah? One based on post-merger cost savings. Okay, how do we calculate the adjustments?
Cost savings times expenses.
Right. So we want to make an adjustment for cost savings, and we did a percentage of expenses. And we'll get into a little bit more detail on that in the full blown, but I want to make sure you just know the procedure. Okay? Once you have revenue minus expenses, what do we have? EBITDA. You subtract revenue less expenses, make the adjustment for cost savings, and you have EBITDA. What's next?
Depreciation and amortization.
Depreciation, which in this case you added acquire plus target. Depreciation, again, it'll be very simple. And then we have our second adjustment. Right, what's our second adjustment? Potentially any new amortization created based on any new intangible assets created after the transaction. Who can explain what this is? Anybody? What's up?
Like
Yeah.
the branding and that kind of thing, or?
Yeah. So, quite often, we discussed before, the purchase price that you're paying for the company, that you end up negotiating for the company, is higher than what the company's been listed as being worth as part of its book value. Right? The company's book value, the company's shareholders' equity, is one representation of what the company could be worth, right, as per the balance sheet. And we'll talk about tomorrow different types of valuation, how to look at public valuation versus book valuation and things like that. But when you negotiate a purchase price for a business, it is most likely going to be higher than the target company's book value, the target company's shareholders' equity. Right? So you need to find some way to account for the difference between the purchase price and the book value. Right? And usually that's goodwill. Right? Goodwill, I'm sure you've all heard of, is the difference between the purchase price and the book value. And quite often, a portion of that goodwill can be allocated, you have to just get it appraised, can be allocated to, as Justin said, brands' new intangible assets. Right? There are tangible assets like property, and then there are intangible assets, patents, brands, copyrights, things like that. If you are able to allocate a portion of that goodwill to intangible assets, you're allowed to amortize it, and it becomes an additional expense. That's a little complicated. But what you did in the model, to make it straightforward from an mechanical perspective, is you took the difference between the purchase price and the target book value. That difference is separated out into two pieces. One piece is goodwill. Right? Goodwill goes onto your balance sheet and sits there, and you'll do that in the full blown. It doesn't affect the income statement. The remaining piece is an assumption for how much of that is allocated to brands or intangible assets. That becomes amortized. So we'll talk more about that in the full blown. That's an adjustment. That's the second adjustment. So your EBITDA, less your depreciation and amortization, less your new amortization, becomes EBIT. Right? And after EBIT, you have interest expense, Where do we get interest expense from?
Just the acquired.
Acquirer only. Right? Acquirer only interest expense. Remember what we said in the beginning, you're adding together acquire plus target all line items except for items dealing with target debt, because you've paid that down. Target equity, you've paid down. So no target debt means you don't have target interest anymore. So you're just taking the acquirer's interest. But you do make an adjustment. Why?
Because if you use debt to finance it.
Right. You do make a new adjustment because we've raised additional debt. We have raised new debt to buy the business. If we've raised new debt to buy the business, we're going to have new interest. And that's simply the debt that we raised times the interest rate. That's the third adjustment. So after your EBIT minus your old acquirer interest, no target interest, minus the new interest, if you've raised debt to fund the acquisition, you have earnings before taxes. Then you calculate your taxes based on the assumed tax rate. Then you have new net income, NI, net income. After net income, to get from net income to earnings per share, we need to calculate our new shares outstanding. So we take our shares, acquirer only shares. Why? Target shares have gone away. Paid them off. Right? They're gone. And we make our fourth and final adjustment. New shares. If we're raising equity to fund the acquisition. Right? If we're raising equity to fund the acquisition, we're going out to the market and issuing shares on our behalf. So we're going to issue shares at our stock price, or really maybe a little discount to our stock price. That's why in the model, you took the acquirer's stock price to calculate new shares. These are our shares that we're raising to get cash to fund the acquisition. So you might have new shares, and also note, if you have new shares, you're going to have more dividends, shares and dividends. So the old acquirer shares, plus the new shares used to fund the acquisition, is the new total share count, and you'll calculate your earnings per share by taking the net income divided by that new share count. That's how you calculate new earnings per share. New earnings per share. And you compare this earnings per share to the old acquirer's earnings per share before the transaction. Or not before the transaction, but without the transaction rolled into it. And you calculate a percentage. And the percentage would show if the EPS has gone up or gone down. If it's gone up, it's called an accretive transaction. If it's gone down, it's dilutive. So to simply recap, because you might get this question in an interview. Very simply, this lays out what a mini-merger is. A mini-merger model, if somebody asks you, how do you do a mini-merger model, I would explain it like this. Think about this. Picture this in your mind and say, first you need to figure out the purchase price. Then you need to figure out the sources and uses. The sources are the purchase price, plus the target net debt, assuming that you have to pay down those debts, plus transaction fees. And the sources are raising debt and raising equity. Right? If you decide to raise debt to fund the transaction or raise equity to fund the transaction. And then you want to combine the operations of the business to determine the earnings per share, the post-acquisition earnings per share. And how do you do that? Simply, you want to add together line by line, revenue all the way down to net income, acquire plus target, except for items dealing with target debt and target equity. So you don't add target interest, you don't add target shares, and then you make 4 transaction adjustments. post-merger cost savings, if any, amortization on intangible assets, if you have any, new interest if you're raising debt to fund the acquisition, new shares and new dividends if you're raising equity to fund the acquisition. That's it. That's the way you explain it. That's what a mini merger model is. So the task today is now, and what Nate's going to go through, how do you think about this on a full-blown basis? Think about the steps that we went through yesterday. Think about how to take these synergies and adjustments and fold it into the model that you built on Monday, right? Or the method of modeling that you did on Monday. And so